Welcome to Traders Expo 2017 here in New York City. I'm Matt McCall. Thanks for joining us today. Dr. Ellman of the Blue Collar Investors joining me. Alan, thank you for joining us today.
Pleasure to be here.
So let's talk a little bit about something that we've been getting a lot of questions about at this event. And I kind of like we're getting questions because the questions we're getting is, we've had this Trump rally, when's the correction coming? We're going to have a crash, bear market, everything negative. Usually when that happens, it means we're probably going to rally for a little bit more, but we should be prepared. How are you preparing for potential pullback in the market with options?
Well, I trade options very conservatively, and one of the things that I do is I select my strike prices when I sell covered call options based on my overall market assessment and chart technicals. So for example, in a bull market, I'm going to favor out-of-the-money calls, but everyone's concerned now about the market turning around. So what you do in a situation like that is you favor an in-the-money strike. So for example, if you bought a stock at 32 and sold the $30 in-the-money strike for $3, you have downside protection by the intrinsic value of that option. So the $3 premium is not all profit. It's $1 of time value profit and $2 of intrinsic value, which means that the 3% profit you have from the $1 time value is protected by the $2 of intrinsic value. When the smoke clears, you have 6% protection of that 3% profit, which is very different from break even. Another thing you could do is you could favor stocks with low implied volatility. So set your target initial return goal a little bit lower, and that will create a little less risk. Using low beta stocks is also a good way to do it. And for those of you who trade puts as well, what you could do is sell an out-of-the-money put, which means the strike price lower than current market value, and if that gets exercised, now you've bought the stock at a discount, and then you could sell an in-the-money strike. So you have protection from the out-of-the-money put, and then you have protection from the in-the-money call. So a stock can drop 8 to 10%, and you still haven't lost any money.
So basically letting the stock come back to you, letting that stock come back to buy the out-of-money.
Exactly, but make sure you trade defensively when you've evaluated the overall market as being bearish or volatile. It's not that right now, but a lot of people are worried about it and anticipating it. So you should be prepared to monitor your strategy based on your overall market assessment.
So with that being said, I assume you're not moving to this strategy right now because obviously we are in a very strong bull market. We've had the Dow, as of this taping, up 12 straight days coming in. And yes, we're due for a small pullback, but everything we're seeing is still pretty bullish out there.
Yes, so what you do in a case like that is you favor the out-of-the-money strikes. Your implied volatility of the underlying securities can be a little bit greater. Now my target when I'm selling out-of-the-money strikes, or even in-the-money strikes, is 2 to 4% a month for my initial time value premium. I'll go a little bit higher in bull market environments because I kind of have the market working with me. I might go up to 6% for near-the-money strikes, 1 month expirations. However, I won't go higher than 6% because then I'm starting to incur greater risk. Covered call writing is a very conservative strategy geared to retail investors, conservative investors, capital preservation, very important. So don't get enticed by high premiums. Be very careful about that, even in a bull market environment like we have now.
That's great advice. Dr. Alan Ellman, Blue Collar Investor, thank you so much for joining us today.
Pleasure.